Now let's bring in our market panel. Joining us is Paul Hickey of Bespoke Investment Group and Samir Samana of Wells Fargo Investment Institute. Guys, welcome. Paul, so
hey.
The table's set. If utilities aren't safe in this environment, can investors really trust that Q4 is going to be that strong? You think so?
You know, I do think so. And what you were talking about in your prior segment is that seasonality, you can't just bank on seasonality to bail you out. The seasonals are certainly working in the market's favor. And October is historically known as the month of market bottoms. More bottoms occur in October than any other month. But when you take a step back to late July, where we were, and the market was at its peak for the year, there were two factors that were weighing on that were working against the market besides the upcoming 2 months, which are usually negative from a seasonal perspective. That was sentiment, which had finally become, individual investors were embracing the rally. Bullish sentiment was over 50%. And you just had a market that we were calling it the summer of overbought because the S&P 500 had been overbought every day from Memorial Day through the end of July, and the NASDAQ from Cinco de Mayo all the way to the end of July. So those types of conditions can't last forever. You had investors off sides in an overbought market. Mm-hmm. And so now what we see at the end of September is things have been completely reversed. Bullish sentiment has been cut in half. And just last Thursday, all of the major index ETFs were trading at what we call extreme oversold levels. Yeah. And the last time that had happened was a year ago to the day in late September of last year. And when you look back at those types of periods, when you have such universal oversold conditions, it sets the stage for the market to do better and put up better than average returns going forward.
Okay. Samir, just going back to utilities and just in general, the fact that you've seen things like Staples selling off and other so-called defensive sectors of the stock market, does it raise the question that what's considered a safety play needs to change, especially in an environment where you have yields higher and investors are going to get paid more to basically sit out in the short term?
Yeah, no, I mean, that's spot on, right? I mean, for about a decade and a half after the financial crisis, people basically crowded into dividend-paying stocks because it was the only place to find income. So staples, utilities, parts of healthcare, parts of telecom, those were kind of the favorites, right? I remember the charts about, the number of stocks in the S&P that yielded more than the 10-year. Well, I mean, now we've basically had, rates go from 0 all the way up to 5, and a lot of those sectors haven't adjusted. So they're incredibly expensive. Some of those revenue streams are what I would call "quote unquote" defensive, but I think you could argue, higher growth areas like technology could also, be part of kind of that, growing, defensive basket. Larger caps more broadly, I think, do pretty well in this type of environment. So, what we would tell people is kind of barbell between large caps and bonds, as opposed to trying to go down some of these rabbit holes with dividend payers.
And just to be clear, Samir, you think stocks more broadly end of the year lower?
We do. So our target range has been for some time 4,000 to 4,200. So while we might have these kind of on-off, types of moves, we do think that we'll end the year pretty much right where we are right now.
Huh. Paul Hickey, I seem to remember you liking small caps pretty well. What do you think about that barbell, large caps and bonds?
Well, so, I mean, small caps, you talk about the valuation problems with the market and how it's richly valued. So you get to a situation where, outside of the 7 largest stocks, the S&P is a much more reasonable market cap. So that's one thing in favor of large caps. You go down the market cap poll and you get like mid caps and small caps trading for 12 times earnings. So they're much more, much more reasonably priced. When you look at bonds, certain areas of the fixed income market, I mean, even at these levels, though, long-term treasuries, it's just not necessarily the most attractive position for you. You can talk about how they yield more than equities, but I mean, for most of history, that's been the case. And from 1982 to the late 1990s, you had the earnings yield of the S&P 500 was less than the 10-year Treasury yield, and that was one of the greatest 2 decades for U.S. stocks in history. So in that respect, I think just because yields are high doesn't mean stocks are unattractive.